All right, guys. So you guys probably know the routine by now. If you'd like to look at a stock this morning, please put it in the comments in the chat. We've got a couple of things that I wanted to talk about. I wanted to just take a look at the most current news and talk about, the likelihood of a recession. I mean, I think it's something that we hear a lot of noise out there, and I wanted to kind of share with you my observation. It's just one guy's observation, and I'll share that with you. And talk about sectors that I think are sectors that I want to invest in because I think they're going to be good for the next 12 to 14 months. And kind of go about it that way. I also want to talk about some stocks that are pretty interesting today. One of them is Broadcom. They announced last night, and their stock really got hit hard in the after hours, and it's still down this morning. So I've done my complete analysis on Broadcom. I can share that with you and see what's going on with Broadcom. DocuSign announced last night. I updated my analysis on DocuSign. I share that with you. And then some people that have been watching wanted to look at some symbols. One of them is TORM. The other one is TPVG. So we'll take a look at those. Looks like Zscaler is one stock that looks like Noam wants to take a look at. So we can definitely do that. Zscaler, I think, did drop considerably. It'd be interesting to see where their revenue landed and all that good stuff. So we'll take a look at that a little later. Keep them coming. Looks like Shadow Guy wants to look at Jackson Financial. I don't know that I've ever seen Jackson Financial. So we'll take a look at Jackson Financial. Okay, so hopefully you guys aren't hearing the feedback anymore, and I apologize if you are. But here we go. So let's start off with the news, the economic calendar. So this was the big report. If you guys saw my live streams earlier in the week, this is the report I wanted to get my head around because employment really, there's two mandates that the Fed has. It's, keeping inflation down. The second mandate is unemployment, and unemployment is probably the principal metric that recessions are measured on, right? If people are unemployed, the country's unhappy, and for good reason. I think it's the proper metric. And unemployment has increased over time. If you look at the unemployment rate, it has ticked up. 4.2 isn't bad. We've had measures of 6%. That's a full-blown recession. So that's a lot of people unemployed. Now, at the beginning of the week, I saw that consensus was that it would come in at 4.2%. And my comment, I think, somewhere was that, hey, if we get to 4.5%, oh man, we're going to have a sell-off. That's going to be very painful. If you have a number that's probably around 4, it's going to be, unemployment's not really a big issue. It's actually getting better. And the market might rally. So we came in pretty much close to what is expected, 4.2. Now, non-farm payrolls did drop a tiny bit from 160 growth to 142. So that is a tiny drop, and it just continues. The news on unemployment continues to trickle in and kind of make the picture a little worse, a little worse, a little worse. Now, something that's an economic topic, but it is very applicable, is that the yield curve. The yield curve is when you compare the 2-year rate of interest on a treasury versus the 10-year. And they really should be that the 10-year is higher than the 2-year. And for a while, we've been upside down, inverted. The 2-year is higher than the 10-year, which it doesn't make sense because if you hold an investment for a longer period of time, there's greater risk. A lot of things can happen. The U.S. can, over 10 years, you can go into a war. You can, all kinds of stuff. You can have recessions. You can have bad things happen, And over 2 years, you have a shorter period of time, less risk. So you should be paying investors a greater rate of return for a greater risk. So the 10-year should be paying more than the 2-year. But for a while, we've been upside down where the 2-year pays more than the 10-year. In all cases, when that corrects and it goes back to where it more traditionally is or naturally should be, we have a recession. And it's beginning to do that. You're beginning to see the 2-year and the 10-year get back to their normal positions where the 2-year is going to be less than 10-year. Now I'm getting into deep economic thought here, right? But I'm a stock investor. I'm a stock investor and I do a little trading. I do a little shorting of stocks. I invest in cryptos. And I want to know the general picture of the economy. And I want to know the general picture of what's going to happen to use it to my advantage as I invest in companies. So I'm not like an economic thinker that doesn't act on anything. No, I want to look at the economic picture because I can use it to better guide my investments, especially as I look at a 12 to 24 month horizon. Hey, what's going to work over the next 2 years? And what variables do I think are going to apply so that I can use that as I establish my plan and strategy for the next 2 years? So that's why I look at the big picture. That's why it's important as an investor. I know there's traders on the stream, totally respect it. You know, you're looking at day to day, you're looking at the volatility of the day. And I'm not claiming to know what you guys do, by the way. I'm not a trader. I'm not a day trader. I'm not a technical analyst. I'm an investor. And as you see my videos, you basically see that. But I look at the big picture. I happen to think that we're probably, in my opinion, there's a 70% chance we're going to see a recession in 2025. We're going to establish a narrative that we're in recession. We have more unemployment. I think the mentality and the sentiment will be that we're in recession. That's really going to affect stocks. And it's really going to affect the stocks that depend on growth, that are like, hey, we're going to change the world. We're going to be awesome and things are going to get better. So that's one area that, you know, I'm going to continue to talk about because it really will move the market. And I can't tell you when exactly. I could just say, if you look at the data doesn't lie. And you can look at unemployment's creeping up. You see a lot of, especially corporations, announce layoffs. So that's happening. The inversion of the yield curve, that's happening. So all these data points, you know, I got to take them into account and begin to just acknowledge it. And we'll see how things work out. But I thought that was interesting to see. Again, the unemployment rate just came in where it was supposed to. So right now, there's no alarms going off. There's nobody that should be like freaking out. Sometimes the news agencies, they do us a disservice where they may take this information and, in my opinion, kind of run with it and go, oh my God, this is going on. Well, there's really not a lot here. There's just kind of like okay, it was slightly worse, but I actually think it's good news that we came in as expected. And we'll see how the Fed reacts to this as they make their announcement on their interest rates. All right, so we have the big picture out of the way. Now let's talk about sectors and where I think the market will do well. So as I have a long-term mindset, but I'm an active investor and I want an investment to do well over the next 12 months. Who wouldn't, right? It'd be silly to say, oh yeah, I buy a stock and I don't care if it goes down 50% in the next 12 months. I know long-term it's going to be a great, you know, company. Yeah, maybe that's somebody's investing approach, but I'd rather have obviously stocks that do well in the near term and do well in the long term. That's what I'm trying to look for. So finding sectors that are likely going to do well is something that I do at the end of each quarter for sure. Sometimes at the end of each month. And I wanted to kind of start with sectors as we kind of get our wheels into motion. And I'll make this as big as I can. And so first, I'm sorting the sector performance, you know, based on the last month's performance. The reason I use the last month gives us the most current data set that shows us a trend. Now, it's not a perfect trend, but it shows us, okay, what worked for the last 30 days. Okay, cool. And I also look at year to date, 1 year, and then 5 year, but let's focus on 1 month first. So financials have been doing quite well. What's been happening in the last 30 days? Interest rates have been dropping fast. This week, the interest rate drops this week have been very, very jagged. Okay, that's very good if you're getting a home loan. It's very good if it's very good that for companies that require financing. And it's really good for financial services companies because when somebody says, hey, I want to refinance my loan, they go to a mortgage lender and they say, hey, mortgage lender, charge me money to redo my loan. And the mortgage lender says, beautiful. You know, I get to charge you fees and I get to get you into a loan. Then I get to sell that loan to somebody and then they give me money. So that company wins. So companies in financial services win. Also companies like insurance companies that are experts at using interest rates and fixed income to make money. As we have changes, those guys tend to be ahead of the curve and adapt quite well. So I think financial services has done well. I'm well invested in financial services. I continue to invest in financial services, and it's been a good space. Consumer discretionary is really hard to kind of grasp, like, okay, this is what it is, because it's so many things, right? But it did well over the last month. So that's where it was. And consumer staples did well. Now that's not a big surprise, because as we get more inflation worries, that's going to do well. And then real estate did well. Interest rates dropping helped real estate companies. Okay, so that's what sectors did over the last month. As I look at the next 12 to 24 months, I'll just kind of go down. I think if you pick the right financial services companies, you're going to do well in that space. My favorite space continues to be healthcare, the right healthcare companies, because they've been left behind if you look at the performance over the last 2 years. But financial services has really good pockets of value, and I continue to buy into financial services companies. Consumer discretionary is, you have to be specific. Like I'm into Nike. I'm into a couple of others that, like Amazon's consumer discretionary e-commerce. I'm buying Amazon as fast as I can right now. I think it's discounted. I think the current price drops that we've seen are an opportunity. So the most capital I'm putting into is Amazon. That's in consumer discretionary. I stay away from consumer staples. And here's why: is consumer staples and like utilities, it's almost like an investor admits defeat. You know what? I'm just going to buy a stock that isn't going to really rise a whole lot over 5 years. If you look at the compounded rate of return on 60%, it's probably around 8 or 9%. That's not very good. If you're admitting defeat on consumer staples or utilities, because this is even worse, 20% compounded annually, that's like 3-4%. Then just buy bonds. Bonds are going to be simpler, lower risk. Why would you expose yourself to a stock that's going to have risk? Because even though you're in a staple, it doesn't mean that they're low risk. It means that you have a lower risk stock compared to a high risk stock, but bad things can happen to consumer staple companies. They can have, let's say, a food company has one of its production lines, create a big health issue. Boom, that company's stock goes down 40%, and your whole rate of return is completely, upside down. So I don't like consumer staples. I own one consumer staple. That's Kroger, food grocer, very well operated. I'm good. I'll have one. That's it. I have one real estate investment trust, and that's CTRE. I've been a happy camper with that stock. It's in the healthcare space where it provides healthcare to the elderly that need medical care. And I also own real estate. I rent out residential real estate to people that rent from my wife and I. So I'm good on real estate. I think real estate, as we head into recession and as we look at the high prices that real estate is priced at, my best guess is that real estate's going to see price decreases over the next 5 years. And real estate moves super slow. Like prices will, glide down very slowly. So as we look at other sectors, so I said healthcare is my number one. I continue to buy healthcare. I continue to buy biotech and high growth healthcare, because again, it was just completely forgotten for a while, and it's really beginning to work. United Therapeutics is my favorite there. I'm sitting on a nice return. It's on certain days, like United Therapeutics is a stock where it's up 2% one day, down 2% the next day. And I think to myself, man, that's kind of crazy. It's down 1 week or maybe for a couple of weeks, 6-7%, and then it rallies 10%. Now, that type of volatility is good for me, because I know I want to be an owner in that company, and I will buy United Therapeutics and as well as Catalyst Pharma and other companies. Technology, you got to pick your spots. I think software within technology is a really good opportunity right now, because it's been left behind, because a lot of the capital in technology has gone to the semiconductor space. And right now, semiconductor is kind of melting down, led by NVIDIA, and we'll see Broadcom in a bit. Industrials is, man, that's a tough one right now. It's like, where are we? At what point is going to be that pivot point where industrials are going to really work? Communication services is good. It's okay, I should say, because the prices are pretty high. The prices are pretty high for Meta and Google Alphabet and Netflix. Their stock prices are pretty high, but they're good companies. Materials is similar to industrials in my mind, which is, I don't know that we've gotten to that pivot point where, okay, we know this is how bad the recession is going to be, and then we can expect some growth in materials and industrials. So I'm being really careful there. So my top rankings are healthcare is going to be good. I think some consumer discretionary is going to be good, and some financial is going to be good. So those are my top three. As we go through, it's about finding quality companies. I think as we head to recession, quality is really important. Like companies that are unknown, companies that are a little riskier, their stock prices will go way down, where quality will, it'll get a haircut, but it'll kind of sustain its value a little better. It'll sustain its price a little better. So Shadow Guy, by the way, 10-2-year curve is low key uninverting. Yeah. It's uninverting. But the rate, we've got to look at the next couple of weeks, and it uninverted slightly this week, and then it went back to being inverted. And I don't know where it's at today, but I think the fact that it went from being clearly inverted to being even was a big move, and it did catch my attention. We'll see where it goes. If it continues to kind of be as it traditionally is, which is the 10 years above the 2-year, that's usually one of the qualifiers that, hey, we're going to have a recession. And it's not like a doomsday kind of message. It's just reality. We have recessions. They're natural. They're okay. We have recessions so that, the economy can slow down. We regather, like certain industries kind of regather and focus on what they do well. Then they start growing again. It's just natural for them to happen. The thing about like some of the business, stock investing channels, the one thing I would be a complainer about is they focus way too much on what the Fed's going to do and how they're going to play with interest rates, which is a story, most definitely. But they really don't focus on what's the outcome or what is going to be the impact on stocks well enough. They just keep repeating the same story as what's the Fed's going to do. It's almost like making it into a soap opera versus really getting into the thought of economically, what's that going to do to stocks? What sector is going to be affected? I think that'd be a more constructive narrative. Okay, so those are sectors. Now let's get into some individual stocks. I'm going to start with Broadcom because I'm ready to go on Broadcom. And it looks like Broadcom has recovered some of its losses from earlier this morning. I was looking at the stock an hour ago, and it was down 7.5%. So it's coming back a bit. Where are the markets trading? Let's see. Oh, they've recovered nicely. See that whole like story I was telling you about, that the unemployment rate, I thought it was, if anything, a slight good news, story, because it came in as expected. That it's not rising. That's kind of like, hey, that's okay news. It's not bad news. Now, it's not great news. Like, oh man, it went down to 4%. That's great news. That means unemployment's going down. So, okay. So unemployment rate's at 4.2, and the markets are responding to it that, hey, we're not too worried of unemployment right now. All right. So do me trash. Thanks for joining, man. All right. So back to Broadcom. So markets are picking up a little bit. Hopefully they have a little bit of green today. It's been a red week. This is a big cap company. And I've been an investor in Broadcom for many years. I bought into Broadcom, mostly bought it, and now I'm shorting the stock. And I'm doing okay with the short position. Now, they have revenue of $46 billion, but I just reviewed Qualcomm. Qualcomm is $40 billion, but they have a market cap of less than $200 billion. And they have similar cash flow. So it's like this company their price is really high. I've known of Broadcom for 25 years. They were founded less than 6 miles from where I live. It's a great success story. Awesome company. But the company's not the stock price, and the stock price is not the company. As much as I like Broadcom, this is a big number, $711 billion. That's a lot of dough. It's a lot of market cap. PE, 139. Okay. That's a big PE. And then analysts are funny because it's a strong buy, but it's only discounted by 22%. Well, strong buy in my mind is this is 80% discounted. It's going to be a big moneymaker, but instead it's like, it's a strong buy and you're going to make 22% if everything goes right. So that's interesting. Now, when we look at Broadcom, their growth is on the surface, it looks really positive, but you always got to make sure you understand a company and what's going on. And they acquired a company, VMware. It's probably a smart acquisition. And, I don't disagree with the acquisition, but when you see growth of the top line revenue, I like to separate acquisition related growth and organic. And when you look at organic, it's 4% growth. 4% is like not very good. I'm going to show you DocuSign next. They grew better, and that was organic. You look at Meta, they grew at like 20% organic. So organic growth is, in my mind, the true measure that I'm looking for, because that tells me, is their product competitive? Do customers like their product? Do more customers decide to be doing business with that company? Organic growth is the metric I'm looking for. So in this case here, the company did do it, a service to investors by saying, hey, I know this looks great, 47%, but if you extrapolate the VMware part of it, we only grew 4%. Okay, cool, thank you. And it goes back to their historic growth rate, okay? So that's a very different picture, right? 4% versus 47%. So keep that in mind. Their cash flow is good, very good. They have a nice upward trajectory on cash flow. Nicely done, Broadcom. Part of the reason why they're such cash rich is they're a fabless semiconductor company. Fabless means they do not own their foundries, so they don't have to put a ton of capital into it. They go to TSM in Taiwan and say, we're going to do all the engineering design. We're going to own that IP, and we want you to manufacture it. So that's why they're such a high cash flow company. And other companies like AMD, I believe, is in the same boat, as well as it seems like the new generation semiconductor companies, NVIDIA is fabless. They rely on TSM. So that's interesting. Now, the balance sheet was a worry in my last report on Broadcom, if you watched my video, but they did do a nice job of paying off debt, and now they're less than 3 times EBITDA. Their debt level is a little under 70 billion, and their EBITDA is 22 billion. So they can pay off debt if they focused, EBITDA on it in less than 3 years. So good job on that, Broadcom. Very good job. When we look at the valuation of Broadcom that I have for them, I have them, and this stock price I don't think is, the market hasn't opened, but I think I could probably 152.82. Wait, that's the 143.03. All right, so the stock price is being sold at a premium of 39%. If I do my analysis on cash flow, and I think this forecast is optimistic because this industry is cyclical. It goes up and down, up and down. I think one of the reasons they bought VMware is they want to get rid of some of their cyclicality. If they're very cyclical, it's hard for them to sustain revenues because when they have their down years, it becomes harder. So in this case here, I just kind of projected it to continue to grow at 6% for the first 4 years and then 4% for years after year 4. I brought down the discount rate to 8.5 since they improved their balance sheet. And overall, if I look at cash flows and add cash and take away debt, the Broadcom stock is being sold at a premium of 44%. You could really see that rise in the stock price just rise beyond their valuation with this AI excitement. Oh man, AI is going to be awesome. Yep, maybe. Earnings per share, and it's good earnings per share number. I use a P of 18, which is good for the semiconductor industry. And that shows a premium of 30%. So overall, I think Broadcom's being sold at a premium. My short position, I shorted shares and sold them and got proceeds from those sales of the short of $5,239. If I closed out those shorts today, I'd have to pay about $4,700. So I'd probably be at a 10 to 11% gain. And the price has moved on me a little bit since I did these numbers. So right now I'm looking okay. And judging from where we're going, right, economy and all that good stuff, and the fact that the semiconductor space is just priced way too high, I'm gonna look for a 30-year return, 30% return on this short position and then close it. Or if it goes the other way, if I start losing money, maybe it gets to 20% loss, I'm going to go ahead and close it and just pay for a lesson that the market will teach me. I'm not a big short seller, but given the market and how expensive some industries are, I think it's an opportunity. And to me, semiconductor is obviously priced too high. I've been an investor in Broadcom for a long time. I've been an investor in semiconductor for a long time. I've been an investor in NVIDIA. And as I look at those numbers and I listen to the stories that are theorizing the AI, universe, I just shake my head and go, man, I can't believe intelligent people could go that far, but they have, and everybody's kind of bought into it. So we'll see. All right. So Trader Prad, thanks for joining, man. And looks like Doomy Trash is on. Good morning, man. Myrello, sorry if I butchered that. Good morning, sir. Thanks for joining, guys. So that's my story on Broadcom. I just recorded a video on them. I just edited the video. It'll release later today. If you want more details, you can watch that video. And I also shorted NVIDIA. Right now I'm shorting two stocks that are, let's see here. So I'm shorting Broadcom and I'm shorting NVIDIA. I'm in the positive on both. And Super Microcomputer ended up being a winner. That was fast. It's become a falling knife. So that short position was a winner. And then CrowdStrike, I shorted CrowdStrike, and that was super fast. In 10 days, I made a nice return on that. Thank you, stock market, for that gain. And I've got other short positions around the AI hype in the data center. I've got a utility, a privately owned, or forget what the industry is called, but it's a utility, Vistra. And I'm up 7% on that short position. And Vertiv, I believe, is another one. And they're in the data center. And I can't find the symbol right now, but that's also a company that they do cooling and stuff, which I understand. And here it is. They're actually an industrial. And I look at their components and go, they could be easily replaced. They're just doing plumbing and stuff, electrical components. And I get that they're in demand right now, but you don't have very good margins, but their stock's just flown off the charts. So that to me is an obvious opportunity. And those stocks now are really beginning to drop, and I'm monitoring them. I may buy more, or I guess it's counterintuitive. I may make the short position larger by borrowing more shares and selling them. That's definitely a play that I'm into with very high stock prices. And the expectation now that I have that we're going to have some type of recession. That's kind of one of the expectations I have, is like, hey, these short positions are becoming a lever that I really want to keep in my portfolio, because I have equities right now, and it's a big part of my net worth, right? And real estate's a big part of my net worth. And I know that if we have a solid recession right now, where's the market trading? So the market should be open, and the NASDAQ's trading up, right? So if we look at the NASDAQ for the last month, we've gotten a small haircut of 4%. We did see a pretty good pullback not too long ago, 13% on the NASDAQ. But if this thing pulls back and pulls back 25%, it's a pretty good haircut on my portfolio. So now how do I diversify away from the pure equity risk, right? Well, these shorts are becoming a nice play. Bonds, I have an elaborate bond portfolio, and I did a video on that like a week ago. I got a lot of views. And bonds and shorts are two levers that, as the economy begins to pull back, and again, it's not the end of the world, everybody. It's like, hey, it's an opportunity to buy stocks. But as that pulls back, it kind of makes the tide of, the alternatives really rise. So I'm really going to put a lot more homework into my shorts. I'm going to be very careful with the risk I'm taking, because one bad short can really ruin my month, quarter. But I think that's going to be a space. I'm glad that I've done some shorts so I can learn. Once I've learned a few things, continue to expand, the capital I'm going to put into it, make it bigger. Because if we do see a solid crash, because I think we're headed towards a correction. I don't know if people are going to argue with me. We're down 4% in 5 trading days. Okay. All we need to do is get to 10%. It's called a correction or a pullback, excuse me. And I'm sorry, it's early. It's a pullback correction at 10%. Once we get like to 20s, we can call it a crash. For sure, I'm expecting we're in a correction. We're going to pull back about 10%, maybe more, maybe 15. But as that happens, how could I like have investments that are going to rise and kind of keep me not outperforming the NASDAQ and the S&P by having part of my portfolio do well in those bad times. So I'm going to put more energy and focus on that. All right, so let's talk about DocuSign. So DocuSign is up 2%. I really like what DocuSign has been doing. So Shadow Guy, you're off to a barbecue. Nice. Enjoy the barbecue. You're living a good life. I like barbecues. I love barbecues. Football and barbecues. The weekend is here. I'm gonna barbecue this weekend. Thanks for the idea. All right, so DocuSign has been doing well. They are growing their business organically, especially during COVID. They became, the digital capture company, and they're growing their portfolio to really expand like digital capture, but they also want to do what they title is agreement management, contract management, so that a company can really hold all their contracts in one place and really do a nice job and have discipline around, their contracts. So they grew nice organically in the last quarter. I think of it around 7%. That's very good. I just showed you Broadcom. They grew 4%. These guys growing 7%. Very good organically. They have a ton of cash, $1 billion. They only have 135 million of debt. So they have net cash of, call it 850. Yeah, about $850 million of cash. They've been buying back shares. If you look at their share count, it's been going down. Very good. So they've been doing a lot of good things, and they were an acquisition target. They were going to be taken private by a private equity group that shows that some of these small software companies are very attractive acquisition targets. Now, I was an Activision stockholder. I owned, $50,000 of Activision when Microsoft decided to acquire them. And it gave me a really nice return because immediately, boom, a big premium. And I happen to think that DocuSign is that type of company that somebody else could acquire them and boom, they pay a premium of, 30, 40, 50%. As well as Zoom is in that category. So these are two reasonably priced, low cap, software companies. They're growing nicely. They have lots of cash. They produce a lot of free cash flow. And their stock price is 57. When I look at their intrinsic value, I still have them discounted by 49% because their cash is just really valuable. They keep growing it really nicely. So you look at their cash, and I think we said this one was more, it was like 980, and then this one was like 150. So their cash is just so valuable. It shows a discount, really nice discount. So I'm going to keep buying DocuSign. I've been buying more DocuSign. It's been discounted recently. I like what they had to say in their earnings. The market likes what they said in the earnings. Just software companies have not been treated like semiconductor companies for sure. And they're kind of being left off to the side as everybody is really, people have been really focused on this AI story, like, oh, what's AI going to do? But I believe that's beginning to fade. I think people are beginning to realize that, hey, it's not that exciting right now. It might be really exciting in 5 years, maybe 10, when we actually do see innovations that are providing a lot of value and making things far better. Right now, that's not the case. You can go to ChatGPT and get it to answer some really good questions, write some stuff, do some stuff that's valuable, but it's kind of like, it's just a very small use case. I want to see big use cases. I want to see big stuff. So DocuSign looked really good. Congratulations, DocuSign, for doing a great job. All right. So let's talk about Zscaler. So I know Zscaler has been really volatile this week. Let's take a look at the monthly. Yeah. My memory serves me right. 21%. Owie. Man, that's bad. Okay. Last 5 days. So they fell off a cliff on their earnings. And if we look at, so talks earnings and investor disconnect. So I'm not quite sure what. So upbeat guidance. Okay, so let's take a look at their financials. So I think we all know what Zscaler does, right? They do security software. This growth looks really good. So their growth is really good. Okay. They had a net loss, but this is all GAAP stuff, so we can't completely buy into it. That's why I use cash flow. Cash flow kind of removes a lot of the GAAP items that are confusing. And they have operating cash flow, very good. CapEx, okay, so they have free cash flow of 154 or so, 154.19. Multiply that times 30, gets me up to about $4.55 billion market cap, and they're at 24. Yeah, I find it hard to buy into these. So this is a software company, okay? This is a software company. This is a software company. 11.89 billion market cap, 24.61 billion. Their revenue, 2.1 billion, trailing 12 months, 2.8 billion. Bigger, smaller market cap. Cash flow. I showed you that these guys cash flow quite well. Cash flow. Free cash flow, 919 million. Free cash flow, 150 million. So you see the big difference in, hey, if you say you're security, you get priced at a certain rate. If you are digital capture, growing really nice, returning a bunch of value to your shareholders, you're priced at this level. At some point, the market will correct this. Right now, it's misaligned. At some point, they'll be like, okay, security. It's just a software company. Microsoft could get serious about security like Apple. Apple, one thing I admire about Apple is they controlled their entire tech stack. And what that means is if you buy an iPhone, they design the iPhone, they engineer it, and they have a manufacturing partner manufacture the iPhone. But they also write the operating system, the Apple OS. And the security is really good on Apple devices because those guys control the whole stack. Microsoft has a different development philosophy where they depend on a lot of companies to develop pieces. It's almost like if you look at Legos, right? If you look at Apple, all the Lego pieces are the same color. It's all designed by Apple. It's all, determined by Apple. Microsoft, most of the Lego pieces are Microsoft blue, but then they have pieces from Zscaler and from this, that, and the other. Well, the latest kind of PC outage just was so painful. You got to think Microsoft's going to be all over security and saying, we don't want to depend on Zscaler or CrowdStrike or Palo Alto for security anymore. Those guys, every time they screw up, it affects our customers big time. So maybe they start pulling that into their development cycles and get rid of the Lego pieces that correspond to Zscaler. That's one of the risk factors that I see for security companies. And they're being valued at a premium, a big premium. So Zscaler had a massive haircut, I think, because investors are getting around. They produce $150 million of free cash flow. There's no way you can get to this valuation based on cash. It's just, you'd have to make stuff up to get to that valuation. And I think that's what's causing the stock price to come down. I'm not a buyer of Zscaler. I'd be a complete pass on Zscaler. I shorted CrowdStrike, made money on that short. Heck, I might even short Zscaler. I should have shorted it 3 weeks ago, right? Yeah, it's been a rough month for these guys. And I don't know that it's going to be all that prosperous going forward. I wonder how CrowdStrike's doing. So here's Zscaler. They just dropped. See, CrowdStrike's still trending down. Let's go to the 6 month. CrowdStrike was just rocking and rolling. Oh man, look at us. We're like so valuable. And then, hey, we just created like a PC outage. And I still remember people coming on the airways for CNBC and stuff and saying, oh, this outage is just like no big deal. It's a, speed bump, da, 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 da. And I was like, you guys are completely disconnected with reality. They just created the biggest outage in the history of computing. I mean, that's a title. You do not want that title. And then the stock price collapsed. And I made quick money on that one. You see that collapse. Well, this space is not a pretty picture, wouldn't you say? Like, you look at the 5-year, this thing rocked. Like, Zscaler was, what was their stock price then? $368 per share. And it got crushed, right? Well, now it's doing the stock market's kind of dumb. Hey, let's do that all over again. Let's bring up stock prices well beyond their valuations, and then we'll crush them down. So no, thank you. I'll play it so I can make money, but it's not going to be by owning this stock, because I think it's going to be a loser. So thanks for asking about Zscaler. All right, let's talk about a company by the name of, or the symbol is TORM, and that's TOR Materials. So TOR Minerals International produces and sells specialty mineral products in the United States, Europe, offers alumina. Okay. Specialty chemicals. It's a very low stock price. Tiny market cap. Holy smokes. 6 million. They are losing a lot of money. The revenue is very high. Interesting. Okay. So they have never been a really high stock. So I don't like stocks that are priced really low, because the confidence isn't there. The market, most investors are going to stay away from low priced stocks like this, because they immediately think risky. So I'd have to know a lot about this company and be very confident that it's going to be a good business, because you can buy some of these. It's good business. They're doing well. They're operating well, and their stock price will still not go up because nobody knows about them. The revenue looks pretty decent on, I was going to say on the growth rate, but last quarters have been bad. Okay. But overall, okay, I get that. So cash flow wise, they did produce $1 million of cash. I mean, this is tiny. How much balance sheet? So balance sheet, they have 3.6 million of cash, and they have 3.5 million of debt. Okay, so they can pay off debt. That's good. I mean, if you have a high comfort level of this company and feel like, hey, these guys just need to do a few things, turn a corner, and it's going to be a $5 stock. I mean, you're sitting on a multi-bagger. It's very easy to get there with these low price stocks. But that's not me. I don't know this industry well enough. I'd have to get my head around it. I'm not seeing enough for me to be like, hey, I want to look into this. So I'd be a passer of this, but good luck with it. It has enough there where you're like, okay, this isn't completely like labeled as a loser. It has enough there where if you really understand their industry and understand the company, take a look at it and see if, like, I'll throw a few bucks at it, because it could really go up quickly. So good luck with that. Okay, so TPVG. So Triple Point Venture Growth. Triple Point Venture Growth is a development company specializing in investments in venture capital-backed companies. All right, so they do venture capital. I usually don't invest in companies of this type. It's just a little too much of a black box. You give them your capital and they do a bunch of stuff, and you can't really track, like, if they're doing well, they're doing poorly. Like my wife and I have a small business. We're thinking of starting a different business. If I'm going to do a venture capital move, it's going to be with one of our businesses. It's not going to be giving it to some other fund manager that's going to make the decisions. That's my decision, by the way. It's like, that's the lane I'm in. I use equities to give me a good rate of return. I use bonds to have my next 5 years of living expenses completely handled. I don't like investing in venture like investments, because I don't have enough clarity and visibility into the business. So this is a small revenue company. Other revenue. Okay, so they're taking the revenue from all the owned companies. Okay, so 124 million. Revenue has dropped. Okay, good. So they've been losing money for the last couple of years. Free cash flow is good last couple of years. So if we took 100 million, yeah, I mean, this does value. Like, if you look at the cash flow of 100 million, that's a third of their market cap. So very easy to see that this could be worth more very quickly. They do have good fundamentals. So they've been on a downward trend since 21. So they're down 60%. So I think one of the trends that's affecting their stock price is small caps have not rallied a whole lot. If you look at small caps, the Russell is the index that follows small caps. It hasn't really done like the NASDAQ and the S&P toward the end of 2023 when we stopped when the big crash, the last crash we had stopped. These guys are up 27%. But if you look at the NASDAQ's up far more. Let me compare that to this. So if you look at the 5-year, the NASDAQ's left it in the dust. Okay. And if you look at the 1 year, the NASDAQ has been 22%. The Russell's been 14%. Now back to triple point. If they own a bunch of small companies, right now, small companies are unappreciated, which is why this stock's probably unappreciated. But I am seeing a lot of value in this company. It's not the right investment for me, but if anybody's interested in this symbol, there's a lot of value there. I'm seeing free cash flows. The revenue looked okay. You know, the latest years were a little negative. You'd have to understand that. So there is value there, and you'd have to be comfortable with what they're doing and believe in them, and then make a decision. So that's my opinion on TPVG. All right, looks like we're gonna do me trash TRMD instead of. Okay, I got it. So let's take a look at TRMD. TRMD. Oh, got it. Okay. Okay. So TORM is a shipping company. Man, shipping companies are. We've looked at 4 or 5 shipping companies this week. I like shipping companies. I've made money on shipping companies. $3 billion market cap. Revenue is $1.6 billion. Okay. And what's their angle on shipping? So they do tankers. Okay. United Kingdom company. So the revenue's down a little bit in the trailing 12 months. It is up in the latest quarter. It is up Q1 of 24. They just had 2 really bad quarters, Q3, Q4 of 23. But man, it's like feast or famine here. High growth, lose some growth. Okay. Free cash flow. So I love seeing, like I showed you Broadcom, like it just goes up nicely, you know, over time. And this one is a little bit of feast or famine. 178, 42, minus 54, 234. So they've had some years, excuse me, when it's really, and these are quarters. Sorry, let me get to the annual. So free cash flow. And this looks good here. Yeah, it looks pretty damn good. So I'm going to use 300 million. And these companies don't get valued very high because they're small caps. They're shipping. It's almost like investors know that, hey, at some point, shipping is not going to be desirable. So they're very careful with it. I think that this is valued fairly because I took 300 million times 10. It's about 3 billion. We look at what one analyst has an opinion on it. He thinks it's 43% discounted. I think that, you know, if you know that they're going to grow, in this case here, they grew 14% in Q2. And their cash flow for the trailing 12 months is 427. But even if I use 427, I get to like 4.2 billion in the market cap. That gives you a nice discount, but not enough, you know, safety in being able to make this investment and feel like, hey, this is going to be a multi-bagger. Like I've been in Zim, and Zim had a really good proposition. I'm going to look at Zim really quick and look at PenL, which are the 2 stocks that I've invested in. So Zim, if you look at the 5-year, it was completely sold off, but their business was like actually stronger than it was here because they have better ships, new ships, and shipping rates recovered. So over the last year to date, it's up 60%. So if you bought it at the right time, bingo, you made money. And that's what I did. So I'm sitting on a nice gain, and my exit price is going to be $30 a share. So this one here, when you look at their financials, let's look at cash flow. So $1.4 billion of free cash flow, and they're a $2 billion market cap. Okay. $2 billion to buy the whole company that produces $1.4 billion of free cash in a year. So let's say one of the viewers is worth $100 billion. And that person decided, I'm going to buy the whole company, and it's going to return $1.4 billion back to me in the first year. That's a rate of return of 70% of free cash. That's phenomenal. So you look at that valuation and you're like, holy smokes, why is the market back so slow? Now, if the market ever realizes that, hey, that is really discounted, well, the stock did trade at one point at $84 a share. So it's very possible, so this one looks pretty damn interesting. And I'm a stockholder in Zim, transparency, but those are the reasons why I buy Zim, man. It's pretty solid. When I compare it to this one, I mean, it's just not as obvious. It's like, wait, they don't produce a lot of free cash. It's kind of like, maybe it's going to be a good investment. It looks like this stock's already risen. The gain's already priced in. This is priced fairly, and I don't like buying fairly priced stocks that are this small. I usually get out of the stocks before they get there. Like Zim, if I value Zim, it's like discounted by 200%. Well, I'm not going to wait for it to get to the price that I think it's valued at. I'm going to take the gain at $30 a share and be out of the stock, because a lot of bad things can happen in shipping. They could have a vessel sink, and that gives them a bad street name, and a lot of bad things can happen. So that's my opinion there. Hopefully you found it interesting. All right. So thanks for clarifying. And I'm sorry that I misunderstood. I used TORM as a symbol and not the company. All right. So thanks for asking, Do Me Trash. Now let's look at JXN, and then I am going to land the plane and move on. Jackson Financial. So Jackson Financial, through its subs, suite of annuities for retail investors in the U.S. Okay, so they do annuities. They're financial services, life insurance, and annuities. So I own Prudential, and Prudential was a good investment for me. Right now, I got out of Prudential. I took a nice gain. These guys usually pay a nice dividend. Yep, pay a nice dividend. And remember, I was talking about some parts of financials are going to work, and they've been working. What's this guy doing here? Year to date, 70%. Beautiful. Yeah, that's a great rate of return. And that chart looks really good. So that's looking good. Market cap of 6.4 billion. So it's a small cap. Revenue is 4.47 billion. They have a very low PE of 3.1. All right. So free cash flow is very high, 5.6 billion in free cash flow. And they're a $6 billion market cap company. So you can see that investors have really caught on that annuities are probably going to do really well. So lower interest rates on an annuity issuer, that might be a problem. So they probably sold a bunch of annuity products to investors that really want to keep, or I should say people that really want to keep it simple. Oh, you promised me a 5% rate of return or 6%, and they buy an annuity. Well, these guys, Jackson, or maybe they sell on behalf of somebody else, they're on the hook to pay 6%. Meanwhile, interest rates keep dropping. Where's Jackson going to make their money? They can't make it on bonds, T-bills, treasuries, because that's only paying 3% now. So where are they going to make their money? That might be a headwind in the future. So I'd be worried about that when it comes to Jackson. So far, so good, right? It's up in 1 year, 129%. I'd have to kind of theorize. I got out of Prudential because I was on a nice gain. I began to worry about interest rates, moving and it becoming damaging. If you recall, like Silicon Valley Bank went, belly up and actually there was a run on their bank because interest rates moved so fast, they couldn't adjust to it. And companies like Jackson and other annuity issuers like Prudential, a declining interest rate, I'd have to kind of think through that and see how's that going to impact them. because I expect interest rates are going to be lower going forward. They've already dropped a lot. Is that going to hurt Jackson? That'd be a big question. The fundamentals look really good, but the stock is priced. It's been going up. So the market has been recognizing that, hey, we're going to buy into this company. How many analysts cover this company? 5 analysts cover it, and they say it's fairly priced. So I do my homework on it. I compare it to at least 2 other companies that are similar to them and see what those companies have going on and see which one's the best one out of the pack. And if you're comfortable, then you're in a position to potentially invest, or maybe that reveals something that becomes just too much of a risk and you avoid it. So I would say look at 3 companies that are similar in this space. Look at Prudential, because Prudential is similar to this. Then make a decision. I'm out of Prudential. I don't think I'm going back in, because I think I just told you that interest rates are beginning to worry me for this space. But those are my comments on Jackson. It does look pretty impressive that they generate that kind of cash. Dividend looks good. I just worry that the stock's already priced at the optimal highest price that it's going to sell at, and there's not much more upside left. If that's the case, investing in this stock was a good idea a year and a half ago, but today, I don't know, may not be. So that's my comment on that. Hopefully it's interesting. I think that was Shadow Guy who asked about that. All right, guys, take a quick peek at the market, see what's going on. What's going on, stock market? You can't do me like this. It was showing some green. I thought, okay, we're going to have a green day on Friday. That would have been nice. I would have played some Green Day, maybe. I like Green Day. Saw them in concert. But what the hell, man? Jeez. Stock market is down. It's been having a horrible week. Dude. Caramba. Man, NVIDIA's had a tough week. Well, I was hoping that I was going to wish everybody a nice weekend, and let's hope that, the markets keep the gains that we were looking at 20 minutes ago, but I'll have to subtract that from my goodbye. Everybody have a great weekend. Don't let this bad stock market ruin your weekend. Enjoy your time off, and I'm going to barbecue. I want to watch some football. Oh, that's going to be fun. I enjoyed watching part of the Chiefs-Ravens game. Tonight, they're going to play a game in Brazil. I think it's the Eagles against the Packers. That should be fun. Those are 2 good teams, very good teams. I think the Packers are on their way up. The Eagles are loaded. I think they're a really talented team. We'll see where they go. And the weekend's going to have awesome games. I'm looking forward to the Charger-Raider game. That's going to be cool. I'm in LA, so that's going to be kind of a awesome game. And should be a nice weekend. And I'm glad that Shadow Guy brought up barbecue, because I haven't barbecued in a while. It's been freaking hot in Southern California, and getting outside is kind of tough, but I'm going to do it. Everybody have a great weekend. Thank you so much for tuning in to the live stream. I'm going to do this every morning as we open the market. And as you could tell, I'm new to streaming, but I'm old to investing. And I hope that what I share on companies and the way I analyze companies is interesting and gives you just one more, more pieces of information as you invest. I also have a lot of videos on my channel that are videos where it's enablement or training. And I encourage you to take a look at those so that you could potentially just, put more tools in your toolbox where you can become a better investor. And I'm going to record more videos of that type. I've been asked, I think there's a lot of young investors that are coming into this community and view my channel. And that's awesome. I think if you invest when you're young, you're going to have more money than you need. I was fortunate to have reached out to a bunch of old dudes when I was a young man and asked them for their advice, and got a lot of good mentorship. And man, their advice was money. Their advice was so valuable. And it put me on a track to always have more money than I ever needed, live in the house that I want to live, take care of my family that I want to take care of. My sons, when they got to college age, was like, hey, pick any college you want to go to. The money's saved up. The money's waiting for you to go. Just pick whatever college you want. And we got it handled. So money buys freedom. Capital buys freedom. Freedom to buy things, freedom to take vacations and so forth. And a lot of young investors are really ready to start learning and investing and seeing their capital grow. And that's awesome. So I'm going to record some videos really targeted at any level investor, any age investor, but really being inspired by the young investor that, hey, starting out, where do I start? So I'm going to go back to the basics and kind of record some videos around that. So if you find that interesting, cool. And I hope also to host some live streams on the weekends, especially, where they're going to be more like workshops. And we kind of go through like the valuation spreadsheet that I showed you. We're going to break it down. We're going to go nice and slow, maybe take 45 minutes to an hour, make it more of a lecture, have people ask questions. And that way people can learn something and put more tools in their investor toolbox. And, again, if you're young out there and you started investing, you started saving, go for it and save more than 10% of your income, and you'll always have more money than you will need. If you invest it right, you're going to see great gains. It's going to start compounding. You're going to be like, whoa, I never imagined I'd have this kind of net worth, and you'll have it. So good job, all investors, and great to have all of you watch the stream and be part of the community. So that's all I got, everybody. Everybody enjoy your weekend. Thanks again for tuning in.